Portfolio Builder members, welcome to our Thursday Trade Alert where we play the TLT and GDX ETFs. Today we had a nice profit on the TLT after, you guessed it, trade talks started to break down. Once again, Reuters came out saying that the trade deal may not be accomplished until next year. So we're having all sorts of conflicting news come out. Let's start off with a quick overview of who we are and what we do, and then we'll jump into today's trade alert and the most topical content I've collected over the past 24 hours. Daily income trade alerts at noon Eastern. This is our current trade allocation. 54% in equities, 38% in bonds, and 8% in gold. We trade the SPY ETF Monday, Wednesday, Friday at noon Eastern, taking advantage of 3 option expirations per week. We trade the Emerging Markets ETF on Tuesdays with 200 shares for every 100 shares of the SPY. And that again is most of Asia. The SPY ETF has 500 companies held within it, and the Emerging Markets ETF has 1,000. So although this does seem like a very simplified portfolio, it's probably much more sophisticated and diverse than the portfolio you currently hold right now. And the next part of the portfolio is what I've seen 99% of all investors don't have, and that's a healthy bond position. We are relatively heavy in bonds and golds compared to most investors, and that's how we're able to generate such consistent income with very low volatility. So on Thursdays, we trade the TLT ETF, which is the long end of the U.S. Treasury market, 20-plus year treasuries. And then GDX, that's your gold miner ETF, which has about 100 different companies in it. So when you think about the TLT, collects tax receipts from 350 million Americans and every single American corporation, you get a feeling for just how diversified and uncorrelated this portfolio is. Our target income is $750 per month per $75,000 invested, or just about 1% a month. Now, a lot of our clients are trading 7-figure portfolios. They appreciate that the largest loss we've had is 1% in a single month. And over a 90-day stretch, we've never lost investors' money. Our average return, coming up on a year now, is 1.35%. Now, some months we're below that figure. Some months we're above that figure. Also, I want to remind you, coming up in an hour and 40 minutes, we have our weekly free educational webinar at 2 Eastern. Check your inbox if you're already on a free trial for the access link 1 hour before the webinar begins. Or if you're just finding us for the first time on YouTube, go to the description box and you can sign up right now. In this educational webinar, I will give you an hour-and-a-half presentation that shows you how I think the stock and bond market will pop and how you can protect your portfolio against the inevitable. Let's take a look at our returns. And what I want to stress to you today is that our goal is not to outperform the S&P 500. It's not to outperform any other advisories on the internet. I pay attention to absolutely zero of our competitors' trade alerts or anything of that nature. Our goal is something much more important. It is to generate consistent profit with extremely low volatility. If you tell me you have a 20% return this year, I'm going to ask you, what was your biggest drawdown over the past 24 months? And if it's larger than 1%, I really don't care what return you've had, because to achieve your return, you had to undertake significant risk. We're sitting on a 15% total return with a maximum drawdown of 1%. So please, if you can find a track record that has a better risk to reward ratio, send it in. We'd love to check that person out. I haven't seen it. The only people who put up numbers like we are the elite hedge funds. We're talking about Ray Dalio, James Simon, those sort of investors, Stanley Druckenmiller. And guess what? Our whole strategy mimics exactly what they do, and that's how they've risen to the top. Okay, so in December, the S&P 500 fell 18%. We picked up a 1% return. If you want to know how on earth we pulled that off, join today's webinar. The answer is the TLT. TLT typically goes up when stocks go down. January, February, we had healthy returns. Everybody did. March, April, same thing. But in May, when your portfolio was down at least 7%, we picked up a 2.2% return. June, a healthy return. July, I was very concerned that trade war was going to escalate after the meeting in Osaka. And surprise, guess what they came out saying? We have a farm deal with China. I've heard that a few times, including recently in October. Well, guess what? By August, there was no trade deal. So what did Trump do? He escalated the trade war. He said we're going to have some tariffs going up by 5% in October during their big holiday annual celebration of the Communist Party. And then he said we're going to have more tariffs on $300 billion of goods December 15th, which are still slated to go up in about 25 days. So we're really getting close to the end of the rope for this trade deal to make some improvements. Now they're talking about delaying those tariffs, but we're in a very risky period of time where if we get a trade war, stocks go up, but if we don't, you can expect what we've seen time and time again, probably a significant sell-off. So over this period of 4 months, I'm very happy with this return because it's really been up in the air. We have a trade deal, we don't have a trade deal. We have a trade deal, we don't have a trade deal. Once again, the market's really gone just about nowhere, and it's on the verge of a massive sell-off because this trade deal is running out of patience and time. Our simple 4 ETF portfolio is extremely diversified and all you'll need for your retirement. Our goal is to generate income and safety, not growth or speculation. I'd much rather have a flat return and play it safe than try to guess what the future holds and cross my fingers to try to hit a big win, which is what most investors are doing who are holding on to equities right now. So this program allows you to simplify your holdings, reduce your risk, get better results with less work, and weather-proof your retirement portfolio. So please call Dean to reserve your spot or get a free consultation. He's an option expert and a coach on our team, and you can call him right now at 505-322-7515. This is our disclaimer. Feel free to pause it and read it. Let's jump into today's trade alert. Still waiting on that trade deal, I see. You can see the poor guy died waiting for it to never happen. First part of our trade alert, which is in your email, is a review of the current trade we're closing out. And on Thursday, it's the TLT and GDX at noon Eastern. So the first thing we want to track is the change in price. And in this case, the TLT went from 138.16 to 139.67. The initial caller, that's the options that protect our position and also help generate income, started off with a debit of 33 cents, and we were able to close it out for a credit of 9 cents. And so the net result was a $1.27 profit, or $4,827 on 3,800 shares in our model portfolio. The GDX, we had a small gain on the underlying and a small loss on the options. The net result was a break even. The next part of the trade alert will review our open positions. Now remember, the strategy is to generate profit on one half of the portfolio at a time. So don't expect, in most cases, for all 4 positions to go up at the exact same time. In general, they're all traveling higher together, and in our webinar, I'll explain why that is the big picture view, at least for the next several months. On the SPY, the current trade went from, and this was from Wednesday through today, we'll close this position out on Friday, and the emerging markets position out next Tuesday. The SPY went from 311.73 down to 310.18. But because we had the 314 short call and the 312 long put, we're actually up $2 on the option contract. Now we did have to pay 87 cents to buy that protection, so the net result is we're down 49 cents right now. So we're down $931 on this position. Emerging markets has a similar story. We're down slightly on the underlying, but the option caller protecting us with that long put at the 43 strike has gone up in value. So we're only down 14 cents or $532. Now, we've been predicting a big ride on the SPY and emerging markets ever since the Phase 1 trade deal was announced. And so you can go look at all our past trades, but you can see we've had a lot of profitable trades ever since this prediction. Every link goes to that trade alert so that you can go back and review every single trade and see how easy it is to get in and out of our positions. We've done the same for emerging markets. Now remember, we only trade EEM on a weekly basis, so there's less trades for emerging markets versus the SPY. Here's a breakdown of the monthly return per strategy. So if we do look at the SPY, you can see we are up 1.3% in November. And on our palette of potential ETFs, and this will be for quite some time, we're all in on the SPY. Next portion of the trade alert reviews our return on the Tuesday trade. Currently we're up 0.3% in November. Now, it's been a little bit alarming that emerging markets has been slacking in November relative to the SPY. And that, to me, indicates that there's some pessimism in a trade deal actually being accomplished. What's even more odd is that we've had very low liquidity flowing into the SPY and taking it to new highs, with most of these highs being reached with the market gapping open from the futures market, bidding the market higher, with trade volumes that are more like half days in summer. So there's very little volume pushing the SPY to all-time highs as everyone is being complacent and holding. Meanwhile, volume is rocketing higher on emerging markets, but it's still not even near its recent high in 2017, and it's not matching the returns we're getting, at least in November, in emerging markets. Now, we did have a nice win in October in this portfolio, but currently it is definitely slacking and giving us a little bit of worry as to the trade deal. The bond portfolio is down 1.6% in November, but it's just picked up a 1% gain in the last week. And that's because the bond market had a little bit of a hissy fit when all of a sudden the market, when Trump came out and said we have a Phase 1 trade deal. So the bond market sold off pretty rapidly, but now it's back on track towards driving to new highs. And the big picture here is that as long as the U.S. government creates deficits faster than it can grow its GDP, the Fed is going to be forced to lower rates and support the government debt by buying up treasuries. So the end of the rope is when we get towards the zero bound of interest rates. And we're not there yet. So the TLT can climb significantly higher. And by my estimation, at least another $40 higher. If you do look at the latest FOMC minutes, there's some pretty interesting things they're talking about as to how they're going to support the bond market when they reach the effective lower bound. And so they're talking about controlling the maximum yield of these bonds. They're talking about unlimited repo. And they're also talking about going into negative interest rates now. So very interesting developments. Also, we're seeing the Bank of Japan talk about going below negative 0.1. And we already have seen that Europe is at negative interest rates. So the big question now is, will the US follow suit? And again, as long as we're creating more debt than we are growth, they're going to be forced to continue lowering rates, supporting the bond market to fund the government. It's just that simple. So TLT is a buy and hold position where we use options to protect our portfolio and to balance out the risk in equities. So right now we're getting some nice gains back in the TLT, and it's been a huge winner for us over the last 12 months. Now, I look at the gold market currently as the bond market on steroids. Gold market understands what the bond market has to do, and it's just lagging a little bit behind. So we like gold if there's lowering interest rates, quantitative easing, and then the main ingredient is panic. And I do believe there's some panic in the cards in the next 12 months, which is why we remain very constructive on the gold miners. Okay, let's take a look at the current trade alerts. So it's important, we do send you these trades via text message. A lot of our clients take these trades on the go, whether it's from an airport, a restaurant, or the comfort of their home. They get this alert via text message so that they can place it and be done in about 2 minutes. Now, probably on Thursday it takes you 4 minutes because there's 2 trades. But we summarize the actions in this text message. Now, one note, next Thursday is Thanksgiving. The markets are closed, so we will be trading this on the Friday, and the SPY trade of that Wednesday will be an expiration onto Monday. I don't want to give you guys 3 trades in a single day, as it's just too much to do. Okay, so let's look at these trades. Step 1 is to buy to close the November 22nd 141 call and to sell to close the 137 put. That gets you out of the trade. If you didn't take last week's trade, you would skip this and go straight to step 2. In this trade, we're selling the 142 call and we're buying the 139 put. So the bottom line is we give up all profits after the TLT goes above 142, which would be a big move. And on the other side, we get a guaranteed price of 139 per share of the TLT if it were to sell off. So an atomic bomb could go off, and in this case that would be negative for the SPY and positive for the TLT either way. I guess in this case, let's say we had a trade deal overnight and the bond market got upset and sold off once again. Well, we would still walk away with 139 per share of the TLT because we paid a measly 53 cents a share for downside protection. And in this case, we financed half of that cost by selling the 142 call. Let's look at our risk-reward ratio. So the maximum loss we can have on this part of our portfolio from now to next Friday is about 0.8%, a little less than 1%, $1 a share against 139 price tag per share currently. On the other side, we can make just under 1.5% return, or $1.94 a share, if we get the TLT to travel higher. Now the big picture is the Fed wants to slowly and gradually lower rates, support the debt, and keep the TLT moving higher. Because if they don't, there will be a whole lot of bond investors who realize that the yield they're getting is less than inflation, and they're all going to rush to the exit to sell these at once. So it does make sense to have that downside protection, even though there's an overwhelming force that will push bond prices higher over the next several years. The next step is to do the same thing for GDX. Buy to close the 28 call, sell to close the 27 put. If you didn't take last trade, skip this, go to step 2. And today's trade is to sell to open the 28 call and to buy to open the 27 put. Same story, we give up profits after 28, but we reduce risk so that we never get less than 27 a share. That makes this trade a lot safer than just buying and holding GDX. Maximum risk is $36 a contract, or 36 cents, just over 1%. And the maximum profit is just over 2% with $64 a contract, or 64 cents a share. Okay, so that's our trade alert for today. Let's take a look at what's going on in the world. Okay, so you can see just how crazy the market is with all of the news headlines coming out. The big news is that the House and the Senate recently passed in the last 24 hours bills to support the protesters in Hong Kong. And this is a big deal to China because they believe it's their property and that they can do what they please with it. But the deal is that this territory was sold to them with the expectation that they would remain a democracy for the next 30 years. But China has slowly but surely tried to take away these freedoms, and every time they've done that, these Hong Kongers love to go out and protest. And so this has been going on for decades, ever since the deal has been sold. And so every several years, this has been repeating itself. This time around is much more televised and is starting to get much more violent than any other protests in the past. And so now the big question at this point is Trump going to sign this deal? Because if he vetoes it, it does appear the Senate has enough votes to overturn a veto. Meanwhile, this is being broadcasted from the communist leaders that they absolutely do not want this bill passed. And the point of the bill is to evaluate whether Hong Kong has remained autonomous with its democracy every several years, otherwise to place sanctions on it. Now, what's important is that this is the hub for China to raise capital. In fact, Alibaba just raised $18 billion in a secondary listing through the Hong Kong exchange. So this is a huge ordeal, and it's getting more violent by the day. Okay, there's a big economic forum with a whole bunch of billionaire Americans who are buddies with the Chinese going on right now, including Bill Gates, Ray Dalio, a bunch of big bankers from Goldman Sachs, JP Morgan, the usual suspects. And Ray Dalio, who has a special license to manage money for the Chinese that almost no other hedge funds have had, has been very vocal about how China is on track to surpass America as the leading power in the world. And so you got to take his word with a little grain of salt. And that's because he has some estimated $20 to $30 billion in assets under management from China. But the guy's smart. He's made more money for investors than any other hedge fund in history. And a lot of our strategies do mimic what Ray Dalio teaches. Now, of course, he's doing this with a $144 billion fund, and we're doing it with a lot less. Because our clients have much less capital, it allows us to be much more nimble and to take advantage of the options market in a way that he just can't. So he's having to plan way ahead of the pack to be able to position his portfolio to take advantage of changes in the economy and politics. Ray Dalio says the global economy is in a similar situation to 1944, it's right around World War II, heading into a new world order. And he's trying to say that China is going to become the dominant power and that you need to load up on emerging market ETF, one of his biggest positions. Chinese Vice President Wang Qishan says the international order is under attack and sensible decisions must be made in the face of challenges. So we're talking about this globalization of corporations and really undermining politics and governments to supersede what these corporations' goals are. And these big multinational banks, it's really being disrupted around the world right now because of the inequality. And we'll see this probably continue to become a bigger and bigger problem. But bottom line, the reason we're seeing so much problems around the world is that rent has gone up and 50% plus of the population's income has stayed flat. And so now they're scrapping to pay their rent and they're upset. Meanwhile, they're seeing the few who do own these banks and corporations are becoming extremely wealthy. And so every time in history this happens, big changes come through and disrupt the order. And so Ray Dalio has a lot of information about this and has written massive books about it, a lot of good content, regardless of whether you want to take his side in this prediction. Hong Kong is not Tripoli. It has the strong backing of 1.3 billion people and 12 trillion USD Chinese economy. If US insists on being a bad guy, China won't sit idly by or blink on issues concerning sovereignty and territorial integrity. U.S. Senator Marco Rubio says, my understanding is the Trump administration will sign the Hong Kong Rights Bill. Beijing may decide to fight and talk alternatively and is now closely monitoring the U.S. president's next move following the vote by Congress. Democrats and Republicans are coming together as I enroll the Hong Kong Human Rights and Democracy Act of 2019, showing a united front in support of the people of Hong Kong. China is watching Trump's response to U.S. Hong Kong bill from the South China Morning Post. U.S. may delay to December 15 tariffs in a pact not reached by then. Kyle Bass, it's asinine to think that we shouldn't force the Chinese companies to submit to the same audits that we require of U.S. companies. Hank Paulson bailed out his banker buddies during the great financial crisis, and now he's a paid propagandist for the CCP, Chinese Communist Party. Former U.S. Treasury Secretary Hank Paulson said, the calls to oust Chinese companies from U.S. stock indexes was a terrible idea. From Bloomberg, who is, guess what, running for president, who's funneled billions of dollars to the Chinese from all of his index ETF products, and who's sold and received tons of advertising dollars from the Chinese. Beijing hopes the round of talks can take place before next Thursday's Thanksgiving holiday and have invited the U.S. officials to fly to China. Okay, they've been doing this back and forth, back and forth. I think they're snickering at how foolish the Americans are at this point. Does not look like the Chinese want a deal. They just want to delay this and try to ruin President Trump's chances of re-election. Chinese Commerce Ministry, China is willing to work with the U.S. to resolve each other's core concerns on the basis of equality and mutual respect, and will strive to reach a Phase 1 deal. This is in line with the interests of both China and the U.S. and the world. Kyle Bass, preparing for the decoupling of a 36-year-old currency peg in Hong Kong USD, brokerage firms are forcibly reducing leverage in their customers' accounts as of today. Here's an email from the broker that they are deleveraging the Hong Kong dollar. The expectations, even with China lovers like Will Rogers, who used to work with George Soros, great investor, big-time pro-China, he even thinks the Hong Kong dollar will disappear at some point, and that even Hong Kong could be replaced with Shanghai. Problem is, Shanghai has no law that Western civilization would like to invest with, as they keep everything top secret as part of the law of the Communist Party. So I don't see that happening. How long will it take the algos to figure out that Li Hu dinner mentioned by Bloomberg took place 14 hours ago, long before the House voted on Hong Kong and the report that would be signed into law? Hank Paulson at the Bloomberg New Economy Forum in Beijing. My good friend Mike Bloomberg asked my good friend Henry Kissinger and me to represent him here today because he's made a decision to serve his country. China needs to make better use of various policy tools to boost the economy. All possible means will be used to lower real interest rates, and monetary policy needs to be better suited to boosting economic activity. So we've been watching to see if China would expand its balance sheets and lower interest rates like the US has done and Europe has done. And now they're starting to follow suit. So we are on full throttle QE around the globe right now, with 60% of all central banks lowering interest rates at this time. Here's a new bridge that China has created for Pakistan. And so the big thing that China likes to do is go build stuff. The problem is they build stuff that no one uses. They have cities the size of New York, skyscrapers everywhere that are empty. Even in the big cities like Shanghai, these big skyscrapers are not fully booked. Companies are leaving China, and they have a huge problem on their hand. They can't keep this 1.3 billion population busy because there's not enough productive work for them to produce. So they binge on debt, keep building stuff that no one wants, and try to grow their bubble. And so they have some 56 million houses and apartments that aren't real houses. They're just concrete shells that they've built and no one would buy. Plus, they're not allowed to sell any property unless it's approved by the local government. So they're trying to force the real estate bubble to continue growing so that it doesn't collapse. So the net result is you just have 50 million homes that are rotting away, crumbling. Global Times, the Hong Kong Human Rights and Democracy Act issued by the U.S. Senate should be renamed Supporting Violence in Hong Kong Act. Hong Kong certainly won't become a fundamental problem for China. So far, China's been pretty good about not creating another Tiananmen Square. I think if it does get bloody and violent, the U.S. administration will use that as the propaganda it needs to get all of our allies to really punish China for all of the unfair trade practices they've had over the last 2 decades. So we'll see if they can continue to bite their tongue and let these protests linger on until they eventually die down. So far, we haven't seen any simmering down of the Hong Kong protests. It just seems to get worse and worse by the day. Global Times, China will be the world's largest economy. It's a matter of time. 5 years or 10 years. I doubt it. So their GDP has crashed from 30% 2 decades ago to 14% 5 years ago to 6% this year. And that's with the ability to have essentially unlimited credit. If we cut off their credit, they are going to go below zero GDP until they can get all of this misallocation of capital out of the economy and restructure to produce things that people actually want to buy. Looks like we're prime time for a sell-off as trade hopes are dying down, but we're still on the hook, and now we have potentially our trade representatives flying out to Beijing once again. Last time they did this, they sat down in some swanky bar, and within hours our team left and flew home because they weren't willing to concede to anything. And so it's just been back and forth, back and forth. We have a trade deal, we don't have a trade deal. We have a trade deal, we don't have a trade deal. Is it making you feel dizzy yet? The longer this goes on, the market implied odds of a U.S. trade deal go lower. So currently it's still at a high probability according to this chart. And the main reason why is no U.S. president has been reelected for a second term when they were in a recession during the election year. So Trump's highly motivated to prevent a recession in the next 12 months if he wants to be reelected. Meanwhile, the Chinese know this, so they're dragging this out till the very last minute. And I suspect that Trump is going to lose his patience and escalate this. But we'll see. Longview used to work for Ray Dalio. He now has a $4 billion fund. Very good Twitter account to follow. He's been trying to go short since last week on the equities. Futures like it. This has become a joke, but remember, Liu also negotiated the failed trade deal she didn't like earlier this year, and this was on some tweets that Premier Liu is skeptically positive on a trade deal being signed. Oh, cautiously optimistic. There we go. Chinese Vice Premier Liu, cautiously optimistic about agreeing to a Phase 1 deal with the U.S. Now, the big problem is Trump has gone out and said they're going to buy $50 billion of agriculture. Most of the agriculture they bought from us was to feed their pigs. But because of the pollution and just overall dirtiness of China, their pig population has been slaughtered. They've lost 80% of their pig population. So they just don't need all the goods we have. Plus, their total purchasing of agricultural products last year was $122 billion. So they're going to have to upset a whole lot of countries and current deals they have to restructure it to get anywhere close to this $50 billion mark. Opinion: the yuan commodity deals can reduce the dollar's hegemony. Boosting global use of the yuan will help ensure China's energy security. So they're trying to get off the dollar, but no one trusts their currency, so I don't see that happening in the near future. Now, if we go blow out our budget with too much deficits, we keep lowering rates to zero, the dollar is at risk. And that is unfortunately where we're headed, but it is quite a ways down the road. Chinese Vice President Wang: China still faces very severe external and internal challenges, has confidence, patience, and determination to achieve Chinese rejuvenation, will stick to the path of peaceful development. So at this point, we're not seeing China try to escalate. It's more like that Joe Frazier-Muhammad Ali fight where Muhammad Ali's just taking all the punches trying to wear out Frazier. So that's where I see the Chinese kind of strategy at this point. Trump expected to sign the Hong Kong bill. Person familiar. We have entered phase -1. This is from Reuters. Completion of a phase 1 trade deal could slide into next year. U.S. President Trump said on Wednesday he has not made a trade deal with China yet because Beijing is not stepping up in negotiations. I don't think they're stepping up to the level that I want. President real Donald Trump said China wasn't stepping up the way he wants in trade talks. Wall Street Journal reports on Apple tour in Texas, but in Beijing, China feels the U.S. is the one that needs to make the next move with a tariff rollback to show sincerity and make a deal balanced. So they just want to call off the whole trade war altogether and go back to where we were before it all started. I don't think that's going to sell well to Trump's base. Trump returns the favor and says China isn't doing enough to make a deal. Trump is looking at whether Apple should be exempt from tariffs. And don't forget, this weekend he announced that there's going to be big bailouts for small farmers. To me, this signals that he is ready to raise tariffs, support the farmers who've been attacked from the trade war, and escalate. Okay, so that's the big news on the China. Let's take a look at some of the U.S. news. And here's the adverse feedback loop between the Fed and trade policy. If we get more tariffs, the economy and market weakens, the Fed eases. That causes the economy and market to strengthen. Don't forget, we have our next Fed meeting December 11th and 12th, and then the following is not until February. So if Trump really wants lower rates and more QE, he's incentivized to escalate this before the December meeting. So we'll see if he does it or if he waits till next year. We'll see. Okay, so here's some U.S. business news. Treasury issuance and foreigners' purchase of Treasury bonds and notes go opposite direction. So we mainly have China and Russia selling or just letting their treasuries expire, and they're using their dollars. China has burnt through $1 trillion US, and they're running out of cash. It does look like they're quite desperate to increase their reserves and to get more debt into their economy because it's deaccelerating so quickly. So from that side, China definitely does want to see some sort of trade deal. But if they have the opportunity to oust Trump and get someone like Michael Bloomberg or Joe Biden, who is pro-China, I think they're going to do everything they can and take the pain for another year. So we'll see. Meanwhile, we're seeing other people step up to the plate to replace these purchases. But mainly, JP Morgan has been loading up on these government bonds. During my visit yesterday to Austin, Texas for the startup of the new Mac Pro and discussion of a new $1 billion campus also in Texas, I asked Tim Cook to see if he could get Apple involved in building 5G in the U.S. They have it all: money, technology, vision, and Cook. Here you go. You can see who's been buying up all these bonds. It's JP Morgan. In fact, they have increased their bond position by 50%. And they certainly have a sweet deal. They are turning around and flipping these bonds they buy. They're a primary dealer, so they have to buy it from the government. The Fed's not allowed to buy it from the government. They're supposed to buy old treasuries. But now they're buying them a day to a week later after JP Morgan buys them for a profit. It's an absolute scam to the American people. But that's what happens when you have a Federal Reserve. That's not government at all. They've just picked that name. It's really owned by the banks. And so what do the banks do? They go loan out a bunch of money that they shouldn't. They should be taking huge losses because these borrowers are not paying back the loans. And then they have the Fed bail themselves out. And so we've seen this time after time after time. Good news is it makes it relatively easy for us to predict these markets. Here's the 10-year yield overlaid on top of the S&P 500. These sorts of charts can be misleading as it does look at a short period of time, but it does show that the bond market is guessing that we're going to have some trouble ahead and potentially a sell-off in stocks. A lot of big names have been trying to short this market and getting their lunch stolen from them. Carl Icahn lost a ton of money on his first big short. Now he's trying to short malls. And so perhaps that's a good trade as we're seeing all the online e-commerce really put malls out of business. Today we looked at that already. The FOMC meetings were very interesting. It's something like 20-page document they produced leading up to the December meeting. And some highlights are that they are now prepared to really do a few things. Number one, everyone's freaked out. What happens when they cut the rates down to zero? Will the bond market freak out and run for the exit because there's no more appreciation in the bonds? So they know that's a big problem headed our way. And so now they're talking about how to deal with that. So number one is that they are talking about unlimited repo, a standing repo that's always available. Number two, they're talking about putting a cap on the maximum yield of a bond. So this would, in effect, limit any kind of sell-off in bonds so that people would have the confidence to buy and hold these bonds. And the third thing they're talking about now is dipping into negative territory in yields. So as long as we see Germany, Japan, and Europe continue to go into lower and lower negative yielding debt, we could potentially see the U.S. start to indicate that they might head that direction as well. And that's very important for trying to time when the bond market will pop. And so if you do join our webinar coming up in an hour, we're going to spend most of the time discussing exactly these topics. Okay, now we're going into political topics, and then we'll close out with stock charts. So we've got these impeachment inquiries going on. So far, it doesn't seem like America is ready to vote for an impeachment in terms of the polls. So we'll see if this really turns into a House vote, and then if it does go to the Senate, if there's 20 Republicans who would flip. At this point, I don't think so. So I'm just watching it. But it is a potential risk to the markets, so we have to pay attention. We get lots of tweets from Trump all day, so he's clearly concerned about it. Jeffrey Gundlach is someone I like to follow. Mayor Pete killed it tonight, he says. Meanwhile, Joe Biden on the Democratic debates, the poor guy can't say a sentence without, he continued to say the wrong thing, flip it back and forth, stumbling on his words. So I think Joe Biden's done. Is Michael Bloomberg going to come in? Will he have mass appeal to poor people? That I don't know. He certainly has the money, and he has won 3 terms in New York as the mayor, so he knows how to run a political campaign. Meanwhile, Elizabeth Warren did look strong. She likes to just give everything for free. She went on and on and on about all the free stuff she's going to give you: free medical, free college, $15 an hour, 2 cents from all the billionaires, 2% of their wealth, taken away every year to fund everything. So that definitely has mass appeal. But all the powers that be want nothing to do with Elizabeth Warren. So we'll see how far she can make it. I'm going to skip through all the inquiry stuff since we're running out of time. New report. So the big information that was withheld from Ukraine that was trying to come over to the U.S. but was blocked was a claim that $7.4 billion was laundered through Ukraine and went missing from the government. So that's the big story, and why I think Joe Biden's really done, beyond him just clearly not able to perform a coherent speech at any debate yet. Okay, so let's skip through this. We're running out of time. Let's look at the charts. So everything is selling off today, although the TLT did gap higher and was up significantly yesterday. That's how we closed a profit. Here's our SPY ETF. My target was 315 on hopes of a trade deal, and with a trade deal, 330. So that's still my targets, but I think the longer the market doesn't get a trade deal, the closer we're going to sell off towards 300. And as soon as we don't have a trade deal, I think we will sell off significantly lower. But because the central banks are in a period of lowering rates and buying bonds from the government, this provides a lot of ammunition for the banks to continue pushing stock prices back up. So any kind of sell-off in the SPY during this period from trade war escalation, we would trade to the downside for a short period of time and then buy the dip. And again, this works until we get to that effective lower bound on the central bank's policy with interest rates. And then, depending on how outrageous they want to get with inflating the money supply and devaluing the dollar, we can start to get to the nitty-gritty details of when the stock or bond market pops and in which order. And that'll be very important for how you protect your assets as we really are getting to the end of the rope. And so we've been in a 40-year bull market, but that's because we came from 20% interest rates down to 0. And now we're just bouncing up and down between 0 and 4. And every time they even try to increase the rates by 1% now, we get a market crash. So the market's become hypersensitive to not only inflation, but also to any change of rates and also quantitative tightening. So they're stuck. They really have no option but to continue lowering rates, print money until inflation really reigns on everybody's day. So here's our TLT. My calculation, just based on getting near the effective lower bound, is at least another $40 on the TLT. Now, if they start talking about controlling the yield and potentially going into negative territory, maybe even higher than that. So we'll have to look at Germany's bond as kind of the best leading indicator for how low can you go. They're a big trading partner of China, and really the health of the global market can be watched just from that one bond price. And we'll look at that chart in a minute. Here's emerging markets over 10 years. And you can see the recent high was 52 in 2017. If we get a phase 1 trade deal, I think we could break beyond 52 because there's going to be massive money printing and more debt going to China. On the other hand, if we don't get a trade deal, I suspect there will be severe punishment to China and this asset could go significantly lower, at least to the low of 2006. Think about the 2016 crash. China did all to themselves just from misallocating their labor to build things that no one wants, like big, massive cities that no one lives in. In this case, we're now applying massive pressure, so they could go much lower than 28. Okay, GDX, if we go back to the last time we did QE, which was at the end of 2009, usually the Fed will wait to do QE until after you have a stock crash. They've actually been very good at predicting stock market crashes and recessions, and you can see that because right before a stock crash happens, they always start cutting rates. Then, usually they wait for the market to crash about 50%, and then they go print money, give it to the banks, and they go buy up stocks at record low prices. And so it's a big scheme, makes the banks rich. This time around, we're cutting rates and doing QE at all-time highs in the stock market. So it's absolute insanity. The debt levels haven't just doubled. They've gone up something like 10 times in the last decade globally. So the amount of money that's going to be printed just to service all the debt that's being created is going to blow people's minds away. In fact, we've added $7.5 trillion of sovereign debt in 2019 alone. We're up to $244 trillion in global sovereign debt. And so as this continues to escalate, so money printing grows faster and faster, and these rates get closer and closer to zero, I suspect GDX will at least go above the 2010 level. Now, the only thing that would save it would be magic from China actually growing GDP without growing debt. Right now, they spend $7 to get $1 of growth. Really bad. U.S. is spending like $1.50 to get $1 of growth. Also very bad. So bottom line is we want to buy and hold gold until we get both the stock market and bond market to pop because inflation is coming in, and we finally get the Fed to say we have to raise interest rates to get all the misallocated capital out of the economy. And that's when you want to bet down on all of these assets. So we got quite a ways before that happens. LQD is your investment grade ETF fund. This is like your Apple, Microsoft, AT&T. At this level, 129, they're getting credit almost for free. And in fact, in emerging markets, they're getting paid to borrow. And what are they doing with this debt? They're buying back their own stocks. When they buy back their own stocks, that reduces how many shares get to share the earnings. So the earnings per share is going up. And this process is, as long as this is going on, it's going to be hard to be bearish on equities for more than a short-term pullback. And again, probably the only thing that would pop this bubble will be when inflation starts to really freak out the Fed and they start to signal they're going to start to raise interest rates again. Now this is your junk bond ETF. You can see it's not nearly as healthy and potentially a better leading indicator for the real health of the credit market. And if we look at the Russell 2000, IWM, also another good leading indicator. These aren't your top companies that get free credit. They're actually having a hard time getting the debt to buy back their own stocks, and you can see it in their prices. So while the SPY is in a clear uptrend, just like LQD, the middle of the market is not, and it's struggling. Meanwhile, we all want to know, what's this repo madness? Who on earth is borrowing $180 billion a night? We don't really know, but there are some pretty good targets out there, so I'm watching them daily now. HSBC, number one, they've been committing so many different frauds and getting caught with it. It's ridiculous. They laid off 10,000 employees. They've lost hundreds of millions of dollars. And the rumor is they were actually trying to support the Chinese yuan through the futures market, which has been obliterated over the last year. So they may have had some huge losses. Number two company to watch is Deutsche Bank. Now they have done a lot of firing of different teams and assets, and they may be okay right now, but the rumor is if they go below 6, that could signal that they're going bankrupt and be a systematic risk to credit markets. So they're pretty close to that. They're teetering on that 6 level, and this stock has lost 90% of its value in the last 9 years. This is the effect of lowering interest rates below zero and then being so tied to China. This is the big German bank. So they are in trouble. Perhaps they're the ones that are being protected with repo. SoftBank is another good target. It's a $100 billion fund that has been invested in companies like Uber and WeWork. WeWork just lost $30 billion in valuation overnight, and Uber continues to just lose money month after month. So it doesn't matter how many hot dogs you sell. If you're still losing 10 cents a hot dog, you don't have a winning business model. And so this is why we have such low inflation. We have free money being lent to corporations who go sell products at a loss to take over market share. And because they're selling these products at a loss, there's no inflation. So the only inflation we're really getting is asset inflation. This won't end well. The other big company I'm now following is Santander. And this is showing a lot of weakness in the car market. These guys are giving out loans to anybody and their mom. And now we're seeing delinquencies grow and grow. It's a several $1 trillion loan market for cars. And now we're seeing more and more delinquencies occur. So this is another potential bank that's in big trouble. Okay, meanwhile, some other assets that are in trouble is the Chinese yuan. I expect within the next several years this will be significantly higher. And we've been ready to short this puppy in our boot camp. We got to wait for this trade deal to fail to have a really surefire profit. Because part of this phase one deal may include rolling back tariffs, which would cause them to strengthen their currency, of course, until the phase two deal fails. So we're on hold to put that trade on. The Hong Kong dollar very well could be dissolved. It is causing a lot of problems for China and costing them a lot of money to keep this peg. So Kyle Bass has been very prolific about talking about shorting it. It has almost no downside risk to strengthen, but on the other hand, it has tremendous upside potential to be devalued and potentially blow out. And so if you go to YouTube and search Kyle Bass shorting the Hong Kong dollar Bloomberg, he has a lot of info going back in history when little countries like this did lose control of their currency, and it can be very profitable. And he's become a billionaire, so he's not a dumb guy, but he's been on this trade for a long time, so he's very patient to hit and win. Gold market's traveling higher. As long as gold prices are elevated, we want to own gold miners. And we've seen central banks are buying up gold at record pace as they continue to print and lower rates. And that's to help increase the credibility of their currency. So I think this trend will continue for the foreseeable future. I take a look at crude every day. At 60, I'm perfectly happy with our strategy. If it dips too low, I'm worried about stocks. And if it gets too high, I'm worried about bonds. Too high oil price creates inflation, negative for bonds. Too low of an oil price potentially represents very low growth and demand for growth. So we want to be worried about our stocks. Okay, here's your German 30-year bond. Again, you can see this is in a downward slope and probably going into negative territory once again. It bounced up on this phase one trade deal, but the second this phase one trade deal fails, I suspect this will go much lower and potentially give the U.S. Fed ammo to teeter on negative interest rates themselves. Currently, our 30 years much higher, close to 2.5. But you can see the U.S. bond is nowhere near as weak in terms of being downward sloped, but it's still following the general path. Finally, the dollar, with all this easing, with the growth of the balance sheet is faster than QE1, QE2, QE3, and QE4. Okay, so we've added almost $300 billion to the balance sheet in 60 days. We're on track to add $60 billion a month, and we've already lowered interest rates 3 times. So you think the dollar would be selling off, but it's still going up. Now, sure, it's flatlined a little bit, but the second we create more tariffs, that's going to cause China to devalue their currency, which causes all of their trading partners to devalue their currency, which in turn makes all of their debt, which is almost completely denominated in US dollars, relatively more expensive. So they print their currency, convert it into dollars to pay their interest, and continue to push their currency lower and the dollar higher. So we've got this huge flood of money into US products, the dollar, the bond market, and the stock market because of this global phenomenon that continues. And this is all because China is slowing down at such a rapid speed. Meanwhile, we've got a sell-off in crypto. Not worried about it. If you're a crypto trader, our portfolio has had a 2% maximum position and has done very well this year. We got in at December levels around 3,500 on Bitcoin and have had quite a ride. I don't think the ride's over. Until the central banks are raising interest rates and doing either no QE or quantitative tightening, we want to buy and hold a small position in Bitcoin. All right, guys, that is a wrap for today's Trade Alert. I really appreciate everyone's time. If you can make it to our webinar in 45 minutes, we'd love to have you there. It's every Thursday, and we'll be going into the big macro content, how to predict the markets and deal with how the Fed really manipulates the outcomes. Thank you.